The golden age of software is over. Over the coming years, software engineering jobs will slowly dwindle. With a simple AI prompt, an individual with hardly any graphic design experience can create stunning AI-enabled Photoshop quality visual effects. The democratization of AI content is here. Who needs to learn complex software and pay a fee for it when AI can simply do it all? But in this age of AI, Adobe just made more revenue than they ever have before. Welcome to the Quality Investor. Adobe just had a record quarter for revenue. They are slowly monetizing their AI offerings, and their stock just popped 15% last week. A few weeks ago, the entire market had left Adobe for dead. Salesforce was crushed in the market when they lowered their guidance. Despite record free cash flow, this signaled the end for the SaaS business model of software. Giants such as Oracle, Intuit, ServiceNow, and yes, Adobe were brought down in Salesforce's wake. The logic is that AI will make development of applications and tools that solve business problems more efficient. This efficiency will decrease reliance on SaaS-based businesses and their high premiums for subscriptions. This will lead to a decrease in seats or subscription licenses that businesses will need to pay to SaaS-based businesses like Adobe. Why pay Adobe when someone can enter an AI prompt and create highly edited, complex, layered, and nuanced graphics and videos? Before getting to Adobe's quarter, please remember to like and share this video below and subscribe to the channel so you can stay on top of all the quality businesses in the market. This video is about Adobe's excellent quarter. It is not about downplaying our AI future or claiming that the status quo will prevail. I believe that AI will change a whole host of industries, not just software. But proclaiming the death of SaaS or software as a service is a bit overblown. The articles that I've read about this are a bit vague in their details of how this will happen or what exactly is being replaced. This article in HFS, Generative AI Eats SaaS. This quote caught my attention. As AI open source tools become more available, this is likely going to accelerate a move away from enterprise SaaS. This trend mirrors the way Salesforce itself led a change to replace monolithic on-premises enterprises applications and ushered in the cloud era. And HFS feels strongly that this disruption is here. The rapid adoption of generative AI solutions to drive software and business processes may only take months. Therefore, many SaaS vendors can expect this shift to increasingly impact sales, pipelines, revenues, and their customer installed base. Now, all of this may happen. I don't think it's going to take months. I think it'll be years, especially for highly complex software such as Adobe or Salesforce. But not only that, all of this is very vague. It doesn't really go into how this is going to happen, what exactly is being replaced. I've also linked to a couple articles below. Rather, what I believe will happen is a bit different. Now, this is conjecture on my part. I don't think we're going to see wholesale replacement of SaaS subscriptions and no-code development. Instead, I think we'll see SaaS businesses like Adobe as the developers of AI tools. They'll then offer them as add-on subscriptions to their core product offerings. In fact, we're already seeing Adobe do this. I also think that there's going to be consolidation in the industry rather than proliferation. In the late 90s and early 2000s, we saw Microsoft gobble up all sorts of competitors. I think we'll see Adobe and other SaaS businesses like Salesforce acquire AI startups in the same vein as their current core offerings. Basically, we'll see a business like Adobe better monetize their AI offerings rather than a VC-backed startup. And Adobe's going to leverage their high brand to do so. Finally, I believe this will lead to an increase in software developers rather than a decrease. Aside from maintaining AI models, which is the main job of developers now, it will allow more people to do even more task and analysis. This is going to lead to an acceleration of output that hopefully addresses real business problems with real business solutions. So, how does this all relate to how Adobe actually performed this quarter? This is a quote from Adobe's earnings call by their CEO, Shantanu Narayan. "We are innovating across data, models, and interfaces and natively integrating AI across all our offerings." He continues on, Acrobat AI Assistant features are now available through an add-on subscription to all Reader and Acrobat enterprises and individual customers across desktop, web, and mobile. We celebrated the 5-year anniversary of Adobe Experience Platform, which we conceived and built from scratch, and which is on track to be the next billion-dollar business. This is Adobe's earnings release from last week. Adobe reports record revenue in Q2 fiscal 2024. Adobe achieved revenue of $5.31 billion in its second quarter of fiscal year 2024, which is a 10% year-over-year growth, or 11% in constant currency. Diluted earnings per share was $3.49 on a GAAP basis and $4.48 on a non-GAAP basis. The other thing that I really wanted to point it out here was this net new digital media annualized recurring revenue was $487 million. They exited the quarter with digital media ARR of $16.25 billion. Creative ARR grew to $13.11 billion, and Document Cloud ARR grew to $3.15 billion. ARR is basically the revenue Adobe can expect if every single one of their subscribers paid in full for the year. But what's important here is that $487 million net new ARR. That $487 million represents 12% new revenue for their digital media segment. So despite all the doom and gloom about AI replacing all this SaaS software, Adobe is proving they're still growing their business. They're adding new customers into the fold. This strength that we saw this quarter, our category-leading solutions, robust pipeline, and tremendous scale position us to drive strong growth in the second half, and we are raising our subscription revenue target for the year. So coming over to their updated fiscal year 2024 guidance, see the revenue is now at $21.4 billion to $21.5 billion. We can see that their earnings per share is at $11.80 to $12.80. I personally like to use the GAAP earnings per share. At the moment of this recording, Adobe is trading at $517.68. It's actually down today, about a 1.45%. But you can see after their earnings released last Thursday, that huge jump over 15%, where it closed the day at $525.31 last Friday. So Adobe had gotten all the way into the 440s. And a lot of people had written Adobe off. They said that their days of growth were over. And a lot of people were questioning whether that subscription model would lead to any more new growth, forgetting they had all these AI tools that they've been testing out now for over a year, and they're ready to roll them out to monetize them to their current subscriber base and hopefully add more new subscribers into the fold as these tools become more powerful. So Adobe finally got back a lot of the losses it's had throughout the year, although this year it's still down for 10%. This is their income statement for the quarter, and you can see the 6 months ended for the current fiscal year at $10.5 billion in total revenue, an increase of 11% over last year. They've also grown their gross profit, and we'll talk about these margins in a second. Now, their operating income has fallen year over year, down to $2.7 billion from $3.2 billion the same period last year. But that's due to this one-time termination fee. This is not going to be an ongoing expense that they're going to have to deal with. You can see their operating income for the quarter year over year is up by 16%. And we can also see that their earnings per share, at least for the quarter, are also up $3.49 this quarter compared to $2.82 last quarter. And they've also been reducing their shares outstanding as a part of their $2.5 billion share buyback program. And speaking of those margins, you can see that Adobe, if we look at their gross margin averages over the last 1 through 10 years here, you can see on a 10-year basis, their average gross margin is at 86.55%. And just last year, they did 88% in gross margins. So their margins are increasing, and you can see that here. And they're on an upswing over the last couple of years as well, including on a trailing 12 basis, an 88.24% gross margin. Same with the operating margin. You can see that increase over the last 10 years or so in their operating margin. And now we have a 35.4% trailing 12 operating margin, up from last quarter by over 1%. So they're increasing their margins. That's what we want to see. We want to see these businesses expand their margins. Their free cash flow margin is down a little bit, but this is due to changes in their working capital needs, so it's not too big of a deal there. But you can also see very good ROIC, and now it's back on the upswing on the trailing 12 basis, as well as return on their equity and a return on their assets. Again, we're seeing a rising trend here. And looking at my scoring here for various businesses, Adobe has a growth score of 3.2 and an economic moat score of 4.73. Please see my videos on the economic moat and growth scoring systems I've devised, linked down below. There's a total score of 3.81. And if we look at that, that puts Adobe right here on this chart of a 5-year score versus the 5-year price return. They've done 13.88% return per year annually the last 5 years, above 10%, above what the S&P returns as a whole. You can see they're well within a very good scoring range here for businesses within the software infrastructure industry. All right, so here's my growth model for Adobe over the next 10 years. You can see I'm projecting 21.3 billion in revenue for this year, slightly below what the low end of their guidance is for 2024. And that gives us a free cash flow of 6.6 billion on the year. Just for reference, analysts are estimating about $1 billion more, over 7.8 billion in free cash flow on the year. So I'm well below what analysts are projecting in 2024. Ultimately, I have my operating margin expanding to 38% by year 10, the net income margin expanding to 30% by year 10, and my free cash flow margin expanding to 38.8% by year 10. I'm also estimating about a 1% per year repurchase. And you can see that ultimately leads to a compound annual growth rate over the next 10 years of 10.6% for revenue, 11.7% for operating income, 11.5% for net income, 12.7% for earnings per share, 11.5% for free cash flow. The free cash flow margin is going to expand at just under 1% per year. And that ultimately gives us a discounted cash flow price of $618.20. So well above their current trading price of $518.84. But are they worth buying right now? I showed you what my base projections are for Adobe, but I just wanted to show you my bull and the bear. So on revenue, my bear case is at 8% growth over the next 10 years and at 12.7% growth for the bull case. I have my free cash flow margin expanding only to 35.5% of my bear case, but expanding up to 42% for my bull case. So my bull case projections are slightly above what analysts' base case projections are. That share price for Adobe keeps creeping back up. We're at $519 per share now for Adobe. So my bear case is at $476.16 for my DCF, slightly below where we're at right now. And as I pointed out before, $618.20 for my base case DCF and $785.40 for my bull case DCF. Right now, my exit multiple is at $470.80. The comps I'm using are Microsoft, Oracle, Palo Alto Networks, CrowdStrike, Synopsys, Salesforce, and ServiceNow. So you can see the upside for each of these cases here, and using a probability of 25% for my bear, 50% for my base, and 25% for my bull, that would give us an average buy price without any margin of safety at about $570.70. With a 10% margin of safety, that's at $513.63. Their share price was a little bit below that to open up today, but it has since increased over to $519. At a 20% margin of safety, it's at $456.56. I want to see that growth continue for Adobe. They had a very strong Q2, but they have to continue that growth for the rest of the year and in the quarters after this year to justify this bull price here. So if Adobe does drop back down below 500, I'm probably going to be a buyer again, but I do want to see that price come down a little bit. We were off to that start today when it opened over 3% down, but like I said, it's been rallying the rest of the day. So when Adobe was trading down in that $450 range, they were pretty cheap at a forward PE of under 40, but now their forward PE is back to 44. So the price right about what their historical averages are. But Adobe is a very strong company, and I'm very confident that they're going to be able to monetize AI and gobble up any sort of AI startups that pose a threat to Adobe over the next few years. Adobe is a strong business model and an incredibly strong brand. And as long as they just diligently increase that free cash flow, Adobe will provide value to shareholders for years to come. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.